exploring the investment landscape with a guru's wisdom and a strategist's insight. Good Life Companies presents The Market Enthusiast with Noah Brooks and Chris Needs.
Welcome, everybody. Thanks so much for joining us today on The Market Enthusiast. I'm Noah Brooks, and with me today, Chris Needs. Chris, 11 months down, one to go. Here we are, and I thought it'd be interesting just to take a quick look back on what happened in 2023. Did anything worth talking about happen in 2023?
Yeah, there was a bunch of notable topics. Several, I guess, we'll go through here. We had the AI boom, ChatGPT.
Oh, right. That seemed to happen at the beginning of the year. Everybody was hot on ChatGPT.
Yes,
right?
yes. So OpenAI released this amount of AI that they had that was, when was it most recent? As of 2021, did they stop feeding into it?
Yeah, December 31st of 2021, because when I use ChatGPT, it won't give me any stats within it won't give me any recent stats. Let's put it that way.
So, I mean, we've had AI for a long time. I think what really opened eyeballs here was they made it available to the public, and people were kind of amazed at sort of the conversational way it answered a variety of questions. You know, it literally seemed as if you had a product expert explaining it to you, and it was typing out in real time right in front of you, no matter what you sent into it. And that obviously led to a number of other things. People started talking about, you know, is this our Skynet moment? You know, do we have a hold on or control of where this is going to go when it starts sort of thinking for itself?
I still think it's going to be Terminators, and eventually we're going to be slaves to the Terminators. I mean, that's how could it not be that, right? Life imitates art. Art says that we're going to be slaves, and so okay. Besides ChatGPT and AI, I mean, we started the year in March. Regional banks. Right. The bears were out in force telling us that this was the beginning of the end. It was going to be, you know, worse than 2008, the global financial crisis. I think we had, you know, 2.5 weeks of pretty significant volatility in March when that came out. Regional banks certainly still have not performed as well as some of the other companies out there, certainly technology. But regional banking crisis was not a crisis, more of just a few week event, right?
Yeah, certainly they were impacted by rates. All of them were. But really what caused the panic, I guess, was those few that really had no risk management in their processes. I mean, Silicon Valley Bank literally didn't have a chief risk officer for about was it coming up on 2 years or so, or a year or so?
Yeah.
And, you know, what did they expect to happen?
Yeah, that seems like a self-inflicted wound.
Yeah, certainly. But it certainly caused a market-wide panic. And just because of they were, I guess, non-granular. They had a certain clientele that they were working with, which was sort of like the San Francisco tech companies, you know, California tech companies. They were nationwide and had companies all over. But you know, it caused panic in a certain variety of people who may have had an outsized influence on things. Think of what Peter Thiel did to sort of spark it off by reaching out to his investors and saying, hey, we're pulling our money out. And then it caused that bank rush that led to the failure.
Peter Thiel caused the crisis?
No, the risk management certainly did. But you talk about the initial catalyst, you know, that guy is held in very, very high esteem with people out there in the Valley. And that's what I heard as the initial catalyst to people start pulling their funds and losing confidence. And then, you know, once those dominoes start, it's hard to stop them.
Yeah, absolutely. So a few other big things this year. Have you heard of Wegovy face?
I haven't heard of that, but I know what you're referencing.
Now, I don't have it. I'm not taking any Wegovy, but obviously this is the year of the weight loss drug. It doesn't seem to be the fen of 2023, but everybody's on it. Everybody I talk to is trying to get it. So these are these GLP-1s, I think they are.
Think of like Ozempics and those things that start off as like diabetic medicines, and now people are using more generally for weight loss.
But so like this is a big trend. I mean, when Ozempic came out or Wegovy came out earlier in the year, and they were doing these studies, and they showed that it actually not just people lose weight, but they stopped in some cases drinking and stopped snacking. It actually caused reverberations in at the grocery store from a stock market perspective.
Definitely did. I mean, we've had portfolio managers tell us it impacted their returns.
Yeah.
I mean, the people who I know are on it stopped drinking soda, started snacking less, started eating much smaller portions. And us Americans love our junk food, right? That's one of the things that's known about us. Our obesity rates are legendary in the world, but you had stocks that were priced for that would continue. There would never be a threat to how much Coca-Cola you're going to drink or how much Hershey's chocolate you're going to have, or
I would say though, this might be a little ahead of you, but back in the early 2000s, there was the Atkins diet, right? Essentially the protein diet, where you stopped eating carbs. And I can remember it was one of the nails in the coffin for Krispy Kreme, right? I don't know how many people actually stopped eating Krispy Kreme because of the Atkins diet, but from a stock market perspective, I mean, it really put a nail in the Krispy Kreme coffin. I doubt, this is my personal opinion, I doubt that everybody's going to go on Wegovy and stop eating, chips. I doubt it. But there's certainly some evidence to suggest that it might be
affect 5 to 10% of revenue, something on the margins.
Yeah.
That is still a big impact.
Yeah, absolutely. One or two other things, big stands out this year. We should talk about oil. Mm-hmm. United States is set to produce for the second year in a row the largest producer of oil in the world. It's significantly more than Saudi Arabia. And I honestly didn't know. I think we're something at like 13.4, 13.5 million barrels, which is a pretty big number. Million a day?
I think 14 million barrels.
14 million.
13 to 14. I've heard
a day. So we obviously had a massive slowdown in driving and transportation during COVID. And then the oil companies cut back production dramatically. They capped wells. Obviously, during the shutdown, nobody was going anywhere, but it took a while to build back up. And now the production is, through the roof.
Yeah.
Through the roof. So I hear some people saying that we need to drill more. And I think we are. I mean, the numbers kind of speak for themselves. We are producing a lot of oil here in the United States, which is awesome. And I would be remiss, two other quick things here. Obviously, we had the terrorist attack in Israel, October 7th. That's certainly on the radar, that it has not stopped. It is still an issue. The minimum thing it is an issue. There's still daily fighting over there, and we're still kind of in a tinderbox in the Middle East. That doesn't seem to be going away. I don't know, is it going to be a catalyst for something more? I mean, some people suggest it is. Some people say, no, it's not that big a deal. It's isolated to that area.
We have two regions that are having sort of this geopolitical strife. Obviously, Ukraine's still going on, and now to bring the Middle East, which historically has always been a real headache in terms of peace.
That's an understatement of the world.
It's certainly not ideal to have multiple fronts that, when we talked before, we were talking about just the U.S. military, and we'll, just in vague terms, we're technically moving on multi-fronts right now. So we have carriers here and there. And
are you saying we're stretched?
I think that's safe to say.
Hey, do you think it would be an interesting time for China to invade Taiwan?
Well, let's hope not. But I mean, what are we going to do? That's a whole nother can of worms.
That's a different day. Last but not least, 52-week highs and new all-time highs on the Dow recently.
Yes.
I mean, that's monster.
Yeah,
that's monster.
I mean, it's great to see those trend change. Sometimes the market can fool you. We know what tech has done this year, but Dow is the first one to make all-time highs again.
Yeah, 37,000
like that. I mean, something else we could certainly talk about is, obviously it's a symptom of high rates, but people started talking about treasury bills this year.
Yeah.
When was the last time people talked about, normal retail investors started asking about treasuries? It hasn't been a thing for a long
time.
We had I bonds last year and tips that people started asking questions about, but this year it's just been straight treasuries.
Yeah.
Good old boring treasuries.
Yeah. Well, so listen, we're talking about 52-week highs, all-time highs on the Dow. I think maybe the S&P is pretty close to there. Perfect time just to look back on November. November was a great month in the stock markets. It was a great month in the bond markets. S&P 500 was up over 9%. Mid caps were up 8.5%. Small caps were up about 8.25%. But and that's great. I mean, these are big months, but bond markets, they were negative, 2% at the beginning of November. And by the end of November, they were up 2%, 4.5 on the ag. Corporates were up even more, probably close to 5.5. And then high yield just, had a massive month. I think for a lot of fixed income investors, people in a 60-40 or 50-50 portfolio, they were really feeling like, hey, this is the third year of fixed income being down, depending on what asset class you're in. And that really starts to weigh on somebody's psyche. And you start thinking, well, should I be in fixed income? And you start looking at all the alternatives to fixed income. And you really start to question the wisdom of some type of 60-40. But I think you have it in your stats. How did the 60-40 perform?
I mean, it performed great. So it was up 7.3% in November. That was the 9th best since 1976. The ag itself alone was up 4.5%. That was its 8th best since 1976.
Yeah.
And the S&P 500 was up 9.1%. That was the 18th best since 1950. So across the board, sort of a banner month, something that, is very welcome. Like we said, defending the 60-40 portfolio, it was struggling almost 3 years in a row. The ag had never gone negative for 3 straight years. And we were preparing to have to, have that conversation.
Yeah.
But,
yeah. I hope that rates don't skyrocket. In December, it doesn't seem like they're going to. We'll get into the Federal Reserve here in a little bit. But we should go back, just talk Thanksgiving a little bit, Black Friday. I know you said you were driving somewhere for Thanksgiving. I wound up driving, a few hours to the North Fork of Long Island from here. And I got back and I got really, really sick. I mean, 103.5 fever, which I keep saying is like a child-sized fever. I got really sick. And the more and more people that I talked to after I got done being sick, it seemed like everybody was getting sick, right? And everybody's broad, but it seems like most everybody I talked to, either their spouse or their kid or someone here at the office was getting sick with me. And I question and I think to myself, are they really getting sick? Is it that we're maybe more attentive to it because of COVID?
I think it's multiple things. Yeah, I think it's hypersensitivity to sickness. I don't know about you. Saz is to say, prior to COVID, I would go into work sick all the time. And it wasn't like a thing. It was just like, I'm not going to use an off day.
It was kind of a badge of honor. I'm in here, I'm sick, but I'm well enough to perform, to do something. And then COVID happened and you weren't allowed to.
Yeah.
Right? If you came in, you were the jerk.
Yeah, for sure.
Yeah. So do you think everybody's gotten sick here after Thanksgiving, or do you think it is simply just that we're hypersensitive to it? And the other thing that I think is everybody's scrolling on their feeds, and I feel like maybe it's a social media that's telling us, not just social media, nightly news, social media, but are we any more sicker than we were a few Thanksgivings ago?
I think multiple things can be true. I think there is hypersensitivity. I think people are talking about it more now, certainly. But, for about a year, and for some people even longer than a year, people were pretty holed up in their house. And it's very possible, immune systems just took some time off, and now they're a little weaker, and now they're getting hit by all these new things. I mean, I know they said there's this RSV out there, you know, all these things. My dad got sick. He was sick for like 4 or 5 plus weeks, and it was like, my goodness, like, when's this thing gonna end, right?
Is RSV new? I'm not familiar with it per se, but
I think it's pretty vague. I don't know, what's it stand for? Respiratory system virus. Like, well, that's like the cold, isn't it? Isn't the cold a respiratory system virus? I don't know, but I guess it's just higher quantities this year, or a different bug coming around, you know.
I definitely hear in Pennsylvania here, they are putting ads on the radio to go get a vaccination for it.
Do you see the ads on TV for Moderna's rebranded thing? I was talking to my wife about this. It's called SpikeVax. That sounds scary to me. I don't like that name, SpikeVax.
It
sounds potent, but I'm not sure if that's like something I want to be.
I have not seen that. We must be watching different. We must be watching different televisions. Different televisions. Well, so listen. So sticking with the watching TV theme here, have you seen the hottest thing on Netflix? Everybody's talking about it.
Leave the World Behind. I haven't watched it, but I have heard several people talking about it.
If I were you personally, I would be really worried. So there's a big scene. Listen, if you haven't seen it and you don't want me to tell you about it, just skip ahead 30 seconds or so. But there's a big scene in there where they're on the highway, they're trying to leave the city, and all of the self-driving Teslas have been programmed to murder people and to clog the highways. Now, you just got that Tesla, right?
Yeah.
So that does that do anything? Do you think, it's not really gonna?
I mean, I see this new recall, 2 million vehicles being recalled. I don't know if they're sending out this software
for the self-driving
patch,
software,
whether they're preventing this from happening, or if maybe they're putting this in there to take us out. I don't know. We'll see.
That would be strange if they did that intentionally.
Hey,
I mean,
unless
that's Elon's plan to take over the world. Okay. So driving, let's go back to that. I think it was AAA came out and said they're expecting 115 million miles driven. 115 million people traveling by driving over the Christmas holiday. It seems like a lot. I think it's the second largest in history. It doesn't feel like people are worried about a recession. It doesn't feel like they're clamping up, although I think a lot of people are kind of, I don't want to say reducing their spending, but maybe normalizing their spending. Going back to Thanksgiving, that Sunday after Thanksgiving was the most traveled airline day ever. 2.9 million people passed through TSA securities in the United States on that day. That's a lot of people.
Yeah.
I would not want to fly on that day. And they're suggesting that the Christmas holiday is going to be even bigger for travel than it has been ever. So it doesn't really seem like it's a recessionary factor. Now, we have some other situations that we looked at, right? Black Friday the numbers came out. Salesforce actually produced the number that said overall spending was up about 6% for Black Friday. Something like $16.5 billion spent on Black Friday, not including Cyber Monday or anything. I don't know why Salesforce has that as opposed to some of the credit card companies, but seemed a little bit strange. It doesn't seem like that's recessionary. The one thing I would point out with that number, if spending is up 6%, that's a raw number, right? That doesn't take into account inflation. So, maybe. But
inflation this year certainly isn't 6%. Whereas last year you would say, well, inflation's running at 7%, so that's not a good number.
Yeah.
We've certainly seen a drawdown in the level of inflation. I saw the Cyber 5 number, which is Amazon Cyber 5, going from Black Friday through Cyber Monday was up 7.6%. So also a pretty decent number. I've heard all these things about Temu, the subsidiary of Pinduoduo.
Is that where you get your shoes from, Temu?
I have bought shoes from them. Hey, man, you get a nice pair of shoes for $8. I don't know who's making it. I don't know or where it was stolen from, but there's some crazy deals on that place. If you're okay with giving up all your credit card information to the CCP, I guess. Sorry.
The CCP. Oh, geez.
I shouldn't have said that.
So one thing I will point out with Temu, I have not bought anything from them, but I've said this to advisors. I've said this to clients. We've essentially been importing deflation for the last 40 or 50 years, right? So looking for the low cost producer of all of our goods, whether it's our shirts, our shoes, cars, whatever it happens to be, we've been looking for the low cost producer. And we've really been in this arena where inflation has been brought in, and I don't mean recently, but over the last 30, 40, 50 years, we're importing deflation or deflationary,
exporting inflation and receiving.
Yeah. And so what happened with COVID is all of that changed, right? And we started importing inflation. And so I guess I think about it now. Now this is just one number. I'm looking down at, I don't know if those are your $8 shoes or not, but
they're not.
They're not. Okay. So thinking about it, like, I feel like we're now back to importing deflation, right? So the supply chain is back. During early 22, right around the time where Russia invaded Ukraine, it was taking months to go from the east coast of China to the west coast of the United States. Those delays are all but gone. We were looking at, they were talking about the number of ships off of Long Beach waiting to get, delivered or to unloaded. And I mean, that's gone. Mm-hmm. The ships that are there are just simply there waiting, a few hours or a day, which is normal. And so I feel like we're back to where we were pre-COVID from a supply chain standpoint. And when I say I feel like it, the data shows that.
Yeah,
right?
We've healed from that shock.
Yeah, we've healed. And so there's a lot of people, or there's at least a few people out there saying that this is just temporary and we're going to have this inflation come roaring back. But the data doesn't suggest that at the moment.
Yeah, I mean, I've been referencing something I've never looked at before. I'll be completely honest. The unit labor costs and productivity numbers, I never really gave much weight to them, but you've seen productivity really moving up, and that obviously, that could be, whether you say it's AI or better automation in terms of, tools being used in the workplace, but that's something that would foster lower inflation over long term, is our higher productivity, and that'll boost GDP. Obviously, the technological factor is a very important part in GDP and future potential GDP. So, it's nice to see those productivity numbers move up. That's something we want to see in the long term that benefits everybody.
Yeah. Well, to go back to where we started with ChatGPT, I mean, the fact of the matter is, technology is going to make life easier for us. It's going to make warehouse life easier and more productive. I don't know where we're going to be in 20 years. Is it going to ruin all the factory jobs? I tend to think not. I think it'll take the hardest jobs and make them much easier. The backbreaking jobs of just, you see it, the moving boxes of the world. Mm-hmm. I mean, why do we need people to move boxes? Why can't the machines move the boxes? And I think that's what we're going to see. So if you go back to the 90s and the beginning of the internet revolution, really what you see there is this massive productivity gains, mm-hmm. right? And I think we're at a spot now where, the next 10 or 15 years could really show us the same type of massive productivity gains from AI, from robotics. There was a factory being built out on the West Coast. And this is kind of the cyborg thing, right? And the Terminators, but you've seen it. They're these Terminator-looking droids, right? That are going to work in factories. They're going to move boxes, and they're being produced currently.
I mean, Amazon definitely currently has robots in their warehouses that are certainly working and doing just fine. I'm sure there's many other companies that use them too. That will probably expand, and they'll probably be even more functional going forward with different gains.
No question about it. And that leads, those productivity gains lead to I would say
maybe at first we'll see all these tech companies like we've seen do really good off of this, or these semiconductor stocks that have launched off the AI sort of boom and hype. And then that should, though, expand out to gains for the larger companies that are utilizing and benefiting from the productivity of them. So it should increase breadth over time.
So you think
as we
the
go
small
on.
companies, the mom and pops of the world, the 20, 40, 50, 100 company, 100 employee companies, probably not going to be using robots. Too expensive?
Most likely.
Yeah. So the big get bigger?
It'll probably benefit, say, the Russell 1000 type stocks. Definitely, not your 10 employee.
There, inflation is healing, right? So a few stats here. We have used cars prices that are continuing to tumble. I think year over year, they're down about 14.5%, which is great. CPI coming out here in December looks really good, 3.1%. PPI's trending at around 2%. I mean, these are all great things. And it certainly helped in November, right? The market had a massive rally and is continuing to rally. So just a few stats that I grabbed this morning. The last 30 days, S&P 500 up 7%. And it is really broadening out. The rally is broadening out across mid caps, small caps, and even some of the large caps, not the Magnificent Seven. So the equal weight S&P 500 in the last 30 days, up 10.5%. Big move. Mid caps, S&P 400 mid cap, up 11.25%. And small caps, baby, they are on fire, up 14% in the last 30 days.
Well, thank goodness, because we've been talking about, how much they've been really lagging compared to, and in part due to the quote unquote Magnificent Seven and leading the mega caps, leading the indices higher rather than everybody else participating. Sort of on that same breath, we're so happy to see that happen, in November and beyond, because we haven't seen that.
Yeah.
So, this year, large versus small, large has crushed small caps.
Yeah.
So we love to see them catch up. The S&P 500 is up 13.7% over the Russell 2000 so far this year. It's only been higher than that twice, the disparity between the two, 1998 and 2021. We also had growth versus value. We had a year where last year value crushed growth, and it's been the complete opposite this year. If you're looking at the Russell 1000 growth, it's up 30% over the Russell 1000 value.
That's a big spread.
Second largest since 1979. Only 2020 had a wider disparity where things were getting shut down. So obviously, without the economy being shut down in 2020, this would be probably the biggest instance. Yeah. So the ratio of the tech sector is now at its highest level in terms of within the S&P 500 since 2000. We all, what happened.
What happened then, Chris?
We had a little bit of a tech bubble.
Yeah.
So, there's just some strange things happening. Market cap indices versus equal weight. Market cap is outperforming by 14% versus equal weight. That's the second largest going back to 1971. And just last one here for you. US is outperforming international, which has been a trend the last 14, 15 years. 11 of the last 14 years, the US has outperformed international. But this year it's up 21% versus the S&P 500 is up 21%. Compare that to the MSCI EFA being up about 13.5%.
Yeah.
And those stats I just read off are as of December 8th.
But I mean, big spreads between those.
Yes.
Big spreads.
And a lot of, second biggest since this time and that time. So clearly, we're dealing with an interesting market the last few years. As everyone knows, since COVID, there's been a lot of exacerbations in trends and things like that.
Well, so the inflation trend seems to be coming to an end, right? A lot of the factors that contributed to massive inflation, right? We had the 9% print back in 2022. I think it was June. Those factors are all but gone. Now, the housing is still sticky, right? So housing prices have not gone down. And, historically, housing prices don't go down unless there's some massive recession, right? So, global financial crisis, housing prices went down. Um, 73, 74, I think houses went down a little bit. And certainly in the Great Depression, house prices went down. Other than that, they don't go down. So I'm not saying they're going to continue with the same increases that they had, but it seems like housing is going to be sticky, but everything else is going to, and again, not go down, but the rate of inflation is going to really trend south. And I think that's why we see November having a massive rally, and then into December things keep moving. And to your point about these big spreads between growth and value and small and large, now we're seeing small caps and mid caps outperform, and it's largely because rates are coming down. So their cost of refinancing capital is going to come down, and maybe they were able to hold off a little bit.
Yeah. Well, we talked about that 2 months ago when, Russell was just getting crushed. It seemed like day after day, month after month. And as soon as yields topped out, I think it was October 23rd. Yeah. As soon as that happened, you started to see the Russell 2000 really crush it. And then we paused a little bit there early December. And then, with the Fed decision, which we haven't really gone into yet, again, we're seeing some movement from the Russell. So it seems like it really was a yield story like we thought. And, we talked about, obviously a lot of these small caps have revenue, but a lot of them aren't profitable. So some of the money that keeps them operational is coming from taking out loans. Well, when you go from taking out loans after COVID at 2% to taking them out at 8 or 10%, depending on the credit quality, you can see how that really drains them of value.
Yeah. My position was that when rates stopped going up, we would get some broadening of the rally. Now that rates are actually going down, I mean, you're seeing big gains in the Russell, some 3% days here and there. I mean, that does not happen all that often.
Right.
So, I don't want to say I hope that the trend continues. I'd like to see small caps and mid caps continue to perform. It seems like even if they had a massive rally into the end of the year, they're still going to be underperforming the S&P 500 and certainly underperforming large cap growth.
Mm-hmm.
But just to see the rally expanding, I think is healthy, because so many people were talking about it was concentrated on those large cap names, those 7 names that we all know. And the fact that it's broadening out gives me hope that we're not going into a recession. Maybe there is a softening and a slowdown, but I don't think we're actually going to get a technical recession. I don't think we're going to see too much of a decline in GDP, if at all. I mean, it's possible. I've been wrong before, but it doesn't seem at this point that that's going to happen. The parking lots where I go are still filled. The shopping centers are mobbed. Restaurants, there's still lines and waiting times for. So I don't want to say we're out of the clear, but the Fed has come out. They're not going to be raising anymore in 2023, and they've told us that they're looking to decrease next year.
The dot plot had across the participants 2 to 4 rate cuts in 2024. So you have 2 rate cuts, 3 rate cuts, and 4. So there isn't a consensus on the dot plots among the participants, but it sort of validates what we doubted to be true, over the last 2 months or so, that there could be the market was pricing in 100 basis point cut by December. I thought that was too quick, but the Fed essentially came out and validated that, and the market loved it. So I think we could go so far to say that the Fed really, they didn't say it, they can't say it, but it seems like they're going to start taking a victory lap.
The all clear, if you will.
Right. So we've gone to the part where we've talked about, it doesn't seem like them raising rates is going to be the cause of recession. It'd have to be something external that causes it, which there can be a shock related to what they've done, but they are not the cause of a recession at this point.
the old adage is you don't get hit by the train you see coming down the tracks. You get hit by the train you don't see coming down the tracks. So we see inflation. It doesn't appear that it's going to break anything at the moment. So there could be something else, coming down the tracks that we can't see.
Yields have topped out, so that sort of hopefully remains. So that's not going to be the cause of another bank crisis or something like that.
Yeah. So the bottom line is inflation seems to be abating. Not seems to, it is abating, right? And most of the factors that drove up inflation in 2022 and into 2023 have all but dissipated. I mean, I don't want to say give the all clear 2024 is going to be a banger year, but it seems like a lot of the volatility is behind us, and certainly the big wave of inflation is behind us. So let's make sure, or let's try to think that that's still done. Let's try to think that that's over. The inflation is over. It was transitory, and we have other things to worry about. Hey, thanks so much for joining us on this installment of the Market Enthusiast. Have a great holiday, everybody. Take care.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.